And welcome back to another Econ podcast with Mr. Hagan. On this Econ podcast, we're going to continue to talk about different types of retirement accounts. I want to remind everybody that this video is not designed to give investment or tax advice. Its purpose is educational only. This videos and other videos in this playlist are designed to teach about different retirement accounts. If you want investment advice or tax advice, please see a professional. All right, so I want to continue in this video to talk about 401ks and 403bs. And actually, what I want to do is go through the mathematics of a 401k and a 403b and do some calculations. Remember that we said on a previous video that a 401k and 403b is a lot like a traditional IRA. You get an income tax deduction up front. You can put in $19,500 per year per person. So you could put in $19,500. Your spouse could put in $19,500. That's going to grow at tax deferred growth. It's going to be that means you don't have to pay taxes on it till you take it out. You can withdraw the money at 59.5. It's going to get taxed as income when you withdraw it, and you can put the money in any mutual fund that your place of work contracts with. And this all assumes that you meet the income requirements and so forth. And of course, I'm doing this video in May of 2020, so these were the rules of the game at that time. This is the three-step process that we're going to follow. We're going to calculate the tax deduction. We're going to calculate how much our money turns into over a time period, and then we're going to get to calculate how much of that we're going to get to keep. Okay, so let's start by looking at an example. So let's say that Dad put $17,000 into his 401k, and he's allowed to do that. He can put in up to $19,500 in the year 2020, and Mom put $17,000 into her 403b. Now, again, these are separate accounts. This is Dad's money. This is Mom's money. It is legally separate. Okay, but we can put it together for the purposes of doing calculations. So we're going to put that money together, $17,000 for Dad, $17,000 for Mom, and that's going to be a total of $34,000 invested in 401ks and 403bs. So we got $34,000 total. We can put that together mathematically. Okay, the total return, let's say they do really well and their investments return 12% per year. That would be great. They face an investment tax rate of 15%. That's the tax rate on your capital gains and your dividends. However, it doesn't matter. This number doesn't matter because you don't pay, because this is tax deferred growth. You do not pay capital gains and dividends on this money each year. So this number, we're not going to need that number to do our calculations. Let's assume that their income tax rate is 25% today and 20% at retirement. And then let's say that they leave the money in for 30 years. So let's do our calculations then. So we have $34,000 is the original contribution. $34,000 is the original contribution. Okay. Now, step number one is we're going to calculate, if we go back here and look, step number one is we're going to calculate the tax deduction that we get, which is our contribution times our income tax rate. So the contribution was $34,000 multiplied by the income tax rate, which was 25% right now. So times 0.25 times 0.25, and that will give you the reduction in their tax bill right now today, as a result of making these contributions to their 401k and 403b. So if you multiply this out, this is going to be $8,500. So that's a pretty big deal. You're going to save $8,500 right now on your taxes. Okay, tax bill is going to go down by that you pay to the federal government. It's going to decrease by $8,500. That's step number one. That's your tax deduction right now today. Okay, step number two is we want to calculate how much this money is going to grow to. So now we're actually going to look at the money that's in the 401k and 403b. So we're going to take our contribution, and that contribution is going to grow at the full total return. That's going to be my R raised to the T power, which is going to be 30 years. So let's go back and look at this. P times 1 plus R to the T. My P is going to be the 34,000. So we got P times 1 plus r to the t. My P is going to be the 34,000. This is step number 2. This is step number 2. So my P is going to be 34,000. That's the 34,000 times my total return. My growth rate is 12% per year, so that's going to go in here for R, and I change that to a decimal, 0.12, so I'm going to get P times 1 plus R to the T is going to be P times 1.12. That 1.2 is my 12% return raised to 30 years, because this money is going to be invested for 30 years. So if we do this calculation, we get this is a very exciting number. And by the way, this is only 1 year of savings. This is mom and dad, 1 year, putting $34,000 into their retirement account, grows at 12% for 30 years. That turns into, here's what I get. I get $1,018,637. $637.35. Round that to 35 cents. Okay? That's how much I end up with. So that's at the end of step 2. So let's see what's happened so far. So far, we got a tax deduction of $8,500. So I'm just going to change my color up for that. So we got a tax deduction of $8,500. That's nice. And now we have the $34,000 that actually got invested in the 401k and 403b. Let's say mom and dad did this, to continue with my same examples. Let's say they did this through Vanguard, through the S&P 500 fund, and the S&P 500 grew at 12% during this time for 30 years. That turns into those two accounts combined turn into $1,018,637.35. That's a pretty big deal. Step number 3, however, we do not get to keep all of that money. The government's going to take some of it. So how much is the government going to take? Well, their tax bill at retirement, the tax rate at retirement for this family is, we're assuming, is 20%. So we're going to take the $1,018,637.35 multiplied by 1 minus the tax rate, which is 0.20. That's the 20% tax rate. That's this. And we're going to do 1 minus that. Why 1 minus that? Because the tax man is going to take 20%. That means that they're going to get to keep, this parentheses is equal to 0.8. They're going to get to keep 80% of this money. Okay, they're going to get to keep 80% of that money. The rest of it's going to end up going to the government. So let's do that. Let's do that multiplication on that. So I put that into the calculator. $1,018,637.35 times 0.8 is going to be 814,000. Remember, this is from 1 year of savings. Okay, $814,909.88. Imagine, by the way, if this family had done this every single year, okay, for their 30 years in retirement. You'd get quite a nice nest egg if all this were to play out. So either way, they're going to get to keep $818,909.89, and that's just the answer that I have down here at the bottom. Okay, $814,909.89, 88 cents. I guess I rounded up here, 89 cents, whatever. So they get an $8,500 tax deduction today, and they're going to get to keep $814,909.89 at retirement. Okay, that's the way it works. That's a pretty sweet deal if you can afford to save and contribute to 401ks and 403bs at this level. Because you got to remember, if you put $34,000 into a 401k, 403b, you will not have that money to spend on buying goods and services. Okay, so that'd be the downside of all this. All right, so there's been another Econ podcast with Mr. Hagan. Thanks for joining me, and we'll see you on the next Econ podcast.